listening to Let's Talk Sustainable Business.
Hi, my name is Bárbara Mendes-Jorge, and I am a sustainability communications expert based in Brussels, Belgium. It's a pleasure to welcome you to this edition of Let's Talk Sustainable Business, a series brought to you by the Conference Board. Today is the first of a two-part episode with sustainable finance and investment expert Marilyn Waite. Marilyn currently leads the Climate Finance Fund, which is supported by the Hewlett Foundation. Previously, Marilyn worked for a decade in the energy industry, managing clean tech, nuclear, and renewable energy projects. Marilyn is also the author of Sustainability at Work, Careers That Make a Difference, which has been called a compelling guide for everyone who wants to have both a successful career and a career that makes a positive difference in society. So the theme for this episode is, what is ESG and why should companies prioritize it? ESG means using environmental, social, and governance factors to evaluate companies and countries on how far advanced they are with sustainability. It sets specific criteria to define ESG systems as sustainable. And as sustainability mainstreams, ESG is an increasingly hot topic. NASDAQ found that investments in ESG grew 42% from 2018 to 2020, and McKinsey state that one of every $3 of assets under management is invested in ESG strategies. And today we're joined by a real specialist in this field, Marilyn Waite, who leads the Climate Finance Fund, a philanthropic platform helping mobilize capital for climate solutions, focusing on capital domiciled in the US, Europe, and China. On the Climate Fund's website, it says, to keep global warming below 1.5 degrees Celsius, investors must invest between $1.6 to $3.8 trillion annually. Right now, investments total a mere $600 billion per year. The Climate Fund focuses on capital allocators across the supply chain, consumers, SMEs, large non-financial corporations, as well as banks and asset managers. And their aim is to drive change through supporting innovative finance and the systemic decarbonization of capital. So welcome, Marilyn. I'm looking forward to chatting ESG and sustainability with you today.
Thank you so much to be with you today, Bárbara.
So, as outlined in the intro, you've had a very interesting career in sustainability, and you've now chosen to mostly concentrate on climate finance. So, can I ask you why you've primarily chosen to focus in this area at this time in your career?
Sure. Well, I was actually working in low carbon energy technology, primarily nuclear energy, but also renewable energy technologies, when I realized that bankers did not get it. They did not understand finance for renewable energy simply because it didn't have the same historical track record as the incumbents, including fossil fuels. So no matter how clever we were in engineering and innovation, we were not going to be able to bring our technologies to market without that finance and investment. So I decided to shift towards the finance, investment, and sustainability intersections.
That's very interesting. How have you found that that's changed maybe in the last 5-10 years? Do banks get it a bit more now, or is there still some way to go?
On one hand, there has been a sea change in terms of realizing that incorporating environmental, social, and governance metrics, understanding risk, opportunities, and impacts just makes business sense. It makes financial sense. On the other hand, there is not nearly enough progress, and we're not going nearly deep enough to truly mobilize the capital needed for solving our most pressing challenges, including climate change, and doing it in a way that works for people and planet.
Interesting. So how optimistic are you then that investment in this area will rise in line with limiting warming to 1.5 degrees?
That's a great question. For me, to be very optimistic is to be naive. We are already at 1.2 degrees Celsius in terms of degrees warming. And we're very close to meeting that threshold of 1.5. I think the scientists estimate now that we're going to reach it at least by 2030. So that is not good news, right? We are currently in the middle of serious heat waves, unprecedented flooding, 1/3 of certain countries being underwater. I mean, you can just keep going down the list of climate related impacts that we're already seeing. So the finance community has conveniently set for ourselves this dubious 2050 climate goal. That is way too far out. It's not serious. And I'm not optimistic, but I am determined to help turn things around as best I can with the resources available, using, of course, and leveraging the communities and the people and resources around me. It is definitely not a one-person job. It is all hands on deck.
Yeah, absolutely. As you say, we're in a year of unprecedented, record breaking temperatures and disasters becoming more and more common. And, this is the thing with human beings. Very often, only when something is affecting them directly can they pay attention, which has been the difficulty in getting people on board to deal with climate change. So I've summarized what the Finance Fund does, but could you tell our listeners in a bit more detail what you're working on there at the moment?
Yes, so perhaps giving a few examples makes it very concrete. So we work on the capital domiciled in China, the European Union, the United States, and we work on this through two primary pillars. One is innovative finance, and the other is systemic change. So innovative finance essentially is anything we can do with our capital to prove to the market that something the market perceives is not viable actually is. And then on the systemic side, it's really how can we make sure the market rules set by regulation, set by habit, set by inertia actually work for people and planet. So concretely, for example, in China, we help to back the CSI Climate Friendly Gene Sinan Index. It essentially is an index that tracks the top 100 climate pure play companies that are listed in China, publicly listed on the Shanghai and Shenzhen Stock Exchange. So we're bringing visibility to those companies, helping drive capital to those companies, and also providing the motivation in the marketplace for the less mature climate companies to eventually grow and scale and to leverage the public markets in a way that's going to be helpful for, of course, people and planet. We also, in the European Union, we backed a bank called La Nef in France, which is a fossil fuel-free, sustainable, ethical bank so that they could help scale their climate-friendly loans and also build awareness around what it is to be a leadership ESG-focused bank. In the United States, we backed Optus Bank, which is also a sustainable bank. It is also known as an MDI, a minority depository institution, and so has both climate friendliness and social justice embedded in their DNA. And we backed them to likewise help scale the climate friendly lending. On the systemic change side, we have backed PCAF, the Partnership for Carbon Accounting Financials, in all of our markets. And actually, PCAF is very global. They have close to 100 trillion US dollars of assets under management in terms of financial institutions that are using the standard. And essentially, it is a harmonized methodology to measure and disclose the carbon emissions of finance. So who cares about the footprint of that specific bank branch? We want to know the core business of the bank, that is to make those loans, provide credit. What is the footprint of that? And that's what PCAF helps to measure. We also have backed the entire climate financial regulatory agenda across our three markets. So, for example, in the European context, the European Sustainability Reporting Standards, or the ESRS, that includes climate, it includes a comprehensive list of ESG metrics, including a number of JEDI themes, so justice, equity, diversity, inclusion themes. And we're still working on getting the SEC in the United States to publish or make final the climate rule and actually release the human capital rule. And in China, there's a number of things that are already moving, from the central bank in China, the PBOC, implementing a green weighting factor, essentially providing a better interest rate or lower interest rate for climate friendly or green loans to their banks. And so across our three markets, we are focusing on both the system and the market examples that help the system move.
Super interesting. So it does sound indeed that you are very determined and able to make some change across the world. That's really positive. You talked about justice, equity, diversity, and inclusion. And actually, you wrote an article for the Boston Globe where you argued that financial regulators are failing to adequately address these intersections with climate investing. So what do regulators need to consider to design these just climate policies?
So regulators need to consider history when determining what's best for future generations. So when we think about climate change sustainability, one of the core concepts is that we are putting policies in place that help us not only today, but also in the future. However, in order to do that, we can't just think about the future. We have to look at the harm we did in the past and if that's been adequately accounted for in designing new policies and regulation. So, in the case of the United States, we have a number of specific, explicit policies that were exclusionary. Wall Street itself started to trade not Apple stocks, but slaves, human flesh.
Mm-hmm.
And that thread has continued not only in the US, but throughout all of the capital markets and various policies globally that have been exclusive for some subset of the population, oftentimes women, oftentimes people of color. I just recently learned, for example, in Costa Rica, the Black population that was there, from the 1800s did not have citizenship until 1949. So think about who has been excluded in the system, including excluded from the wealth building, and intentionally address that. So forget the blindness. This is not about blindness. It's about explicitly being conscious of the historical oppression and rectifying that by helping to create this new green economy, but in ways that is going to benefit all people and the planet.
Yeah, wise words there, I think. And it links to kind of my next question because we've talked about sustainable investing, climate-friendly banks, etc., etc. But often climate is only related to the E in ESG in people's minds. So how do you see the social and governance parts of ESG interacting with the work you do on climate finance, and how can we better link them with climate goals when they're so often seen separately?
Right. So that is definitely, I think, a huge mistake to view climate as an E only issue.
Mm-hmm.
Climate is an ecological crisis, it's a humanitarian crisis, it's an economic crisis, it is a public health crisis. I mean, it is all of those things. It's really difficult to silo climate as I think has historically been done. So climate change exacerbates all the things that we would ideally like to improve. And so the it is important to view climate as a cross-cutting crisis and problem and to address it from all angles with all hands on deck. I think also, unfortunately, there's a siloing among a number of E, S, and G topical areas. I think we have overlooked tremendously governance. That is the
Mm-hmm.
foundation of making everything else happen. So, I think the governance at the national level, the subnational level, and the corporate levels are all vital. Forcing people to pay taxes to a so-called royal family has no place in a sustainable economy where equity and inclusion are centered. So we have to go back to the basics in governance. And I mention this because so many European economies still have kept these, outdated systems of governance like the monarchies.
Mm-hmm.
We also have what I call Louis XIV governance, especially in the European Union, where there is not a truly equitable approach to decision making,
Mm-hmm.
where you do have a multi-stakeholder process, where you do value sustainability as a skill set. Sustainability is credentialed. It is not just something that anyone can say anything about at any time. Yes, we do need everyone to become more competent in ESG and sustainability, and it is credentialed. There is depth to it, and so I think there's a lack of recognition of that competence, and a lack of centering that competence as well in the governance. So we're still missing a lot of what's needed to really drive value in terms of shareholder value and returns and long-term profit and so on, and also value in terms of the kind of world we want to live in. I would say the people of the global majority, the most of the world's population, is actually not looking to maintain this world, right? Why would we want to maintain all of the all of our issues that we have in the world? We're looking to create a better world. So I think that's a very important concept for those who are in the environmental space and the climate space from a more ecological angle, that most people are not interested in maintaining the status quo. We're looking to create something better, one that is inclusive and equitable. And so that's an opportunity. That's the positive side of ESG.
Super interesting. I think, on the social side, some people, see some links like, I don't know, conflict minerals or child labor, but actually the governance point, I really don't see being made so clearly. So super interesting. Thanks, Marilyn. So to maybe inspire people at the end of this part one, you've already given some examples, but are there any other regions or countries designing progressive climate finance policies which we can be inspired by? Are there any companies you'd like to shout out for centering ESG in their business models? Who can we be inspired by?
Yes, there is great news. So I would say
Good.
on the on the banking side, aligning one's bank, whether you're an institution or a household, with sustainability, with climate friendly banking. There's tons of resources. So you can look at Bank for Good, which is currently in the US and is expanding to the European Union. You can look at GAVI, the Global Alliance for Banking on Values, which is completely global. They have a database. You can look at B Lab's website database for B corporations, so B Corp certified banks. If you're in the EU, or not just the EU, but broader Europe, you can look at FEBEA, FEBEA. They are an association of ethical and sustainable banks and other financial institutions. You have credit unions. So credit unions are not-for-profit cooperative banks, essentially. So, for example, the Clean Energy Federal Credit Union. So there are all of these examples of associations of banks and other financial institutions that are leading, that have ESG in their DNA, that are fossil fuel free, that are literally, I think, paving the way. Likewise, on the retirement savings or more like public equities, investment fund space, you have a number of resources. AskSustainable.com is an excellent resource that includes also the banking side, but also the investment side. I will shout out Sphere. So I recently served on their board, but oursphere.org, they have a number of resources for aligning one's retirement with climate friendliness, and they have their own mutual fund product that passes a number of sustainability filters, including climate. And so on and so forth. There's just an abundance of resources available that show companies, including financial companies, that are definitely leading the way.
That's great. Any regulators you think that are doing a good job in any regions or countries, or is no one perfect yet and we're just at the beginning?
So it really depends on the kind of regulation. So for sure on using the mandate of central banks, China is leading the way. So the People's Bank of China has a green supporting factor, as I was mentioning earlier. So if you want to do green lending as a bank in China, you can have a lower interest rate. And so that's helpful. No other central bank in the world yet has done that, but that is,
Oh, wow. Okay. I would have
yeah.
thought more people would have been doing that by now, but interesting.
Yeah. So it's actually, the amount of subsidy to fossil fuels is exorbitant. And one of the biggest subsidies happens through central banking. The inherent risk and volatility of lending to fossil fuels, which we absolutely have to get out of if we're going to maintain this planet, is not taken into account at all in the macroprudential rules or the interest rates that are provided to the banking systems, except for in China right now. So there's a lot of work to do there, but that, I would say that's a good example. So we have, I think, in the next few days, the ESRS will be final. And within that, you will likely have scope 1, 2, and 3 emissions being required for disclosure for companies of a certain size if you're doing business in the European Union. And already the European Banking Authority, EBA, has started to require banks to measure and disclose their financed emissions. So there is some movement there. There is, I would say we're doing not so bad on a strictly greenhouse gas emissions basis. We're doing horribly on everything else that matters to make those reduced emissions actually matter, right?
That's my feeling as well,
Yeah.
having worked in sustainability for a while as well. Well, yeah, thank you for mentioning ESRS. We will definitely come back to that in part 2. But for now, thank you, Marilyn, for joining us today. This is the first of a 2-part episode, so join us next time for the next part. And thanks to our listeners. If you enjoyed this episode, please remember to subscribe to this podcast series and explore the entire catalogue of podcast programming from the Conference Board by visiting our website at tcb.org/podcasts. See you next time.
That was